ABC company issued 10,000 compulsory cumulative convertible preference shares. It's called CCCPS. So cumulative means dividend is mandatory financial liability. It is no optional. It is compulsorily convertible. That means my principal is equity. So what is the nature of this? Which is compulsory convertible. No? So it is an equity, right? Unless if it fails fixed for fixed test. As of now, we will assume that conversion is fixed for fixed. If that is the, otherwise, if it fails fixed for fixed test, entire instrument is a financial liability for me, because dividend is anyhow liability, principal also becomes liability. Now, when as on 1st April at 150 each, so this is the issue price. The rate of dividend is 10% payable every year. The preference shares are convertible into 5,000 equity shares at the end of 5th year. Okay, chalo. So this is the case where it is passing fixed for fixed term. 1,000 into 150 is the money what I received. In return for this, I will pay you compulsory interest every year. But I will give you 5,000 fixed shares. When the CCPS are issued, the market rate of interest for similar debt without conversion option, okay, it's not a conversion option, without this conversion feature we can say. It's the conversion feature, no? It's 15% per annum. Yeah, you can just. Now, up to this, everything is fine. Then they said, look, transaction cost is 2% of the value of the proceeds. And now the moment transaction cost comes into picture, we understand that we need an EIR. If they don't give, we have to calculate it. But anyhow, they told you new effective interest rate. So now this 15 is the discount rate because it is an off-market instrument. 15.86 is that 2% of the transaction cost which I need to amortize or whatever I need to do. But is that 2% of the transaction cost should I amortize? Is that full amount I should amortize? No. I need to bifurcate into equity and financial liability. On the financial liability component only, I will be amortizing. Now they gave you certain more details. Here they have given you number of shares, face value. Oh, chalo, they helped you by telling the total proceeds also. Rate of dividend, every information they have given you. Transaction cost amount also they give. Face value of the shares after conversion, number of equity shares. Now why they give face value, we don't know. Now you are required to compute the liability and equity component and pass the journal entries. Okay, since they said compute, I can always all the time what we used to do, transaction price minus fair value. In this fair value working we are doing here only. But let us do it first, calculation of the fair value of the instrument, and then we will compute the liability on this and pass journal entry specifically when entire term of the arrangement from the time it is issued till its conversion. Okay, so we are going to learn, previously we used to just bifurcate it. This time we are going to learn how to do the entire accounting of a compound instrument. Okay, so what is my first thing? Okay. Sorry? If this was not given, then see, if this was not given, then you can reasonably assume, because if it is not given, do you know whether it is a fixed or variable? Unless they tell you variable. So it is a subject matter of assumption. Yes, your question is very valid. If this question is very silent, they said compulsory convertible, but the question is very silent, how many number of shares? Then it is a subject matter of assumption. Now tell me, which is reasonable assumption? Because if there's somewhere they give the hint that it is variable conversion, then there is no question of assumption. But if the question is totally silent, what is your assumption? You should assume fixed for fixed, because there is not even a single question. Theoretically there are questions. Practically there are not even question where fixed for fixed test fails for compound instrument. Followed, no? So by looking at this question, you should know. And I told you, I am showing you how many examination question we discussed in now. Every question shows that it's okay, where it is coming from. By looking at it, you understand, oh, I have seen this question. Followed, no? Yes. So what we need to do first? Is it a theory? Huh? Yes. No, no, no. It is going to happen right now only. I know how many shares I'm going to convert that. If that, I will assume fixed for it. Why I need that information? How many number of shares? Why do I need? What I will do at the end, I'll tell you that point. At the end, when I'm passing entries, I'll make you very clear. What difference it makes to me, whether they give me number of shares or if they don't give me number of shares. With that, it will be clear rather than I'm theoretical explaining. Should I write theory here? How many marks question is this? 12. On what basis I said 12? Probably this may come for 12 marks. No, see, understand, we get marks only for MTP and examination questions. RTP and study material questions we don't get. What I have done, I have applied my judgment, I have taken certain references. So when I have given marks, please always in FR, other subjects you forget. You don't have that problem. In FR, look at the marks to figure out, is it a trap? Other places they don't trap you like this. You should know. I showed you 2 traps. 4-mark question, half 15 minutes you have to spend there. Trap. 10-mark question. I remember yesterday. Yesterday I could not. I was encouraging you. You make mistake and all. But Baba, yesterday is not a this thing. Like yesterday you made one mistake, no? 4-year life was there. 5th year. It's not a mistake, Baba. It's a crime. Actually. Later I remember because you are all happy. When I told you, if I was there, now I suddenly remembered, if I was there in your position, my day would have lost. I would have thought, why did I make this mistake? Why on earth I made that mistake? But that is called, what is that called? Sadness, no? One element of sadness, none of your faces I could see yesterday. Everybody happy, enjoying, you made a mistake. And I also encourage, no? You also, sir, you're also telling, no, make mistake. We made mistake. You are feeling proud. Other things, fine, Baba, okay. But how come that problem you made a mistake? Did you reflect? Reflect? No, I don't think so you reflected. Did you reflect? What really went there? What was the problem? You don't read the questions. You don't have that much of patience. You want instantly output. You want correct answer right now. Arey Baba, read the question. No, why you are not spending time on the question? So unless you figure out what is your mistake, no, you will not improve. Another type of, then see, why we should learn from our mistakes? Because another situation comes, need not be same situation. But this learning will help me there. I'll become more serious when I read that question. Is that not the mistake that you didn't read it? You did not seriously read that question. That's the thing. So I remembered yesterday while walking, I was just feeling like how I missed to tell you that. So going forward, students, see, when you make mistakes, I always welcome mistakes, but it makes sense only when you reflect on that mistake. Why did I make this mistake? Feel sorry for that. I will encourage you, do mistake. But inside, no, you should shrink. I should not, this not acceptable from me. Then you see, no, you will become very strong. Okay, let us come back. Follow, no, in FR you have got a trap of marks. Huh? So 12 marks you have to write. So what is, should I write theory here? Should I write theory? No, verb is very silent. But we understand though, verbs they will give you like this in the study material. Have I given you an author comments there? No, that means they're really not expecting theory in the study material. And I think must have given some comment, T, C, in the bracket T, C, or there, okay. Here there are some small bracket, no? Somewhere T means theory, TC means theory and calculations, C means calculations. Generally I just give that. Yes, there is no theory here. First we will write the fair value. Calculation of fair value of debt, because we need to compute. This is working note 1. What is my fair value of the debt? Only interest is financial liability. Therefore, fair value is equal to 15 lakhs. 15 lakhs, no? Into 10%. This gives you the interest portion into 3.3522. You can say working note number 2. Working note 2 and present value annuity factor is equal to, you can write 1 divided by 1.15 to the power 1 plus 1 divided by 1.15. And why we are doing all this stuff? 12 mark question students. We don't know. Otherwise, somebody may ask you, had they given you these present value factors in the examination question? No. I don't know. This may have weightage. Actually, not there. Okay. I'm just telling you one question to tell you not to take the risk with the bigger questions. Smaller questions, not all this stuff not required. And if you see the solution also, they have not given. But somewhere in one of the solutions they have given. Plus 1 divided by 1.15 to the power 3 plus 1 divided by 1.15 to the power 4 plus 1 divided by 1.15 to the power 5. This gives you 3.3522. Followed, no? See, now first you calculated the annuity factor. Based on that, you calculated the present value of the debt. Now, therefore, now calculate the debt and equity component. Transaction price minus fair value of debt. Our normal format. Okay, so here I have written theory, but not required. You can just ignore that because it's not a theoretical question. So transaction price is 15 lakhs. Fair value of the debt is 5,02,823. You get 9,97,177. So debt value will be 5,02,000 and equity value will be 9,97,000. If they ask me calculate, I don't get into all those businesses. If they say me compute, this question comes for 5 marks. Forget all this headache. But look at the marks and do it in a very detailed way. Now, very clear. First, you calculated an annuity factor. Using this annuity factor, you calculated another component. And then you went to the step number 3. This is called compute actually, where step by step you go to the next one. Yes, first part of the question is done. What is the second part of the question? Did they ask you? No, what is the question? Sorry? Pass the journal entries. Okay. But first they asked what is that called? You are required to compute the liability and equity component. Okay, this is my liability and equity component. But to pass the initial recognition entry, I need an allocation. Then I will do second allocation of the transaction cost. Which one? This is the dividend, no? On face value, 10% dividend we have paid. Followed, no? Not clear? This is my contractual. Principal we didn't consider. Why? Because principal is the compulsory conversion. That's why always don't write the number. Just feel, is that number reasonable? Because your calculation mistakes can happen. Now, does it make 9,97,000? Yes, obviously, because principal you will never pay. But if there was an option, both principal and interest are the component are your financial liability, then this amount is small, 73,000 for you should make sense of that number. Otherwise, you will never realize that you made certain mistakes. That's called a reasonableness test. looking at somewhere reasonably you should know. Okay. Next, how do I allocate it? Second, allocation. Liability component will be 30,000 divided by 15 lakh into 5 lakh 2,823. 492,767. That means this 32. Okay, sorry. I'm sorry. This will be 10,056. And equity component will be 30,000 divided by 15 lakh total instrument value into 9,97,177. This gives you 19,944. So when you pass that initial recognition entry, initial measurement entry, will you add the transaction cost or will you deduct the transaction cost? Deduct the transaction cost. Okay, so this is that respective you need to do. Bank account debit net of transaction cost and respective amounts you need to deduct. So you can pass the recognition entry now. And the effective interest rate is going to be changed from 15 to 15.86. You can always write that. Because of this allocation, effective rate is going to change now. Previously you would have used an EIR of 15%. But now you are going to use the EIR of 15.86%. So what is my recognition entry? Journal entry on initial recognition. Can you tell me, students? How much? $14,70,000 to preference shares in bracket financial liability. How much? $5,02,823 minus 10,056 gives you 4,92,767 to equity component of compound financial instrument, which is 9,97,177 minus 19,944 gives you 9,77,233. You clear? Yes, with this we have passed the first journal. What should I do next? See, first we have always have the workings. What is that? Liability calculation, splitting. The moment I do that working, and that working is needed one. See, students, accounts is very simple. Correct, no? What is accounts? This is accounts. This is accounts. Which account debited, which account credited. Now, you may find accounts difficult because it has got a flavor of mathematics, which is measurement, which is the central theme actually. Things like in measurement, no? And these measurements come from our mathematics. But the principles, whether you add there or minus there, that depends upon what you have done here. Have you credited or have you debited? Plus and minus there comes from debit and credit here. But the calculations and all are measurement principles. Followed, no? So in order to do this number, my objective is to pass the journal entry. Today, first or last. But to pass this journal entry, I get into certain workings. Did. Okay. What else should I do next? On second day, this entry I passed on 1st of January, say for example. Do I have entry on 2nd January? No. 3rd January? No. My books of accounts will get closed when? 31st December or say 31st March. Do I have any entry? End of the year? Yes. Can I pass that entry straight away? No. What I need now? I can pass, no. But to pass the entry, what is there? But the problem comes where you don't know certain numbers. What value I should put here? For this, what should I do now? Amortization schedule. Okay, so let us prepare an amortization schedule. Date 31st March 12, 13, 14, 15, 16. This is a 5-year instrument. What was my opening balance? Where do we find this? You go to the journal entry. See, that's why now you make a practice, students. Generally, I may present amortization schedule first and then I start with the journal entry. But you always make a practice for yourself only so that you don't miss. First, give the journal entry and then you prepare amortization schedule. Why? Because you can look at that journal entry and see in front of that liability what value you added. That value you get here, 4,92,767. Clear now, everyone? Now, what is my interest cost or income? Interest cost at 86. This 0.86 increased because of the transaction cost amortization, which comes to 78,153. Do I have any CCF? Yes, how much? 1,50,000, 10% of what I am paying. So what is my closing balance? 420, 920. Now onwards, you know, no, it's an administrative thing. You just go on like this, fill in the blanks. The last year interest you adjust, it comes to 20,506. And the closing balance becomes 0 because you don't pay any principal. Otherwise, the last year would have been, say, 16,50,000 last year if you would have paid the principal. Since it's compulsorily convertible, you don't pay any principal back. You pay only interest for 5 years. And that interest present value at 15.86 is this. But this is not the fair value. If you discount this at 15%, then you get the fair value. Very clear? Yes, students, you can pause the video and complete this. Okay, so let us pass the journal entry now. On when? 31st March 2012. So my accounting entry will be finance cost account debit, which I'll take to P&L account. How much? 78,153. Alternatively, after doing all the workings, after you get the confidence, do working note 1, 2, 3, 4, 5. Or you first page, 2 pages you leave blank. Then do the working notes. And then start plotting the journal. If any space is left in the examination, say you plotted up to here, this much space is left, because you all have 2 pages, no? Strike it off and write working note next page. That's another way. That's also better. Followed, no? Because if you open any suggested answer, working notes always follow. Main thing comes and they give a reference. Refer working note 1, refer working note 2. That is also best practice. Just leave this 2 page or 3 page blank. Just strike it off. Don't worry. Nothing. They have to evaluate every single page. So finance cost account debit, then please help me. Please help me. Sorry? I don't know. You tell me the journal entry. I'll pass one single entry only. If you want, you can pass different entries. Financial account, you want single entry or different entries? Single entry. Okay. Financial cost account debit. I told you. Should I debit anything or credit anything? Huh? Okay. I say preference shares, no? Financial liability account debit. How much? 847. How did you get this? Can you figure out anywhere? No. The difference between what you pay interest versus what you actually account it as an expense. The difference between these two. To bank, because you paid actually 1,50,000. If they say this is paid on 1st of April, be careful. Be careful with the institute with the dates. Is it a financial year or is it a calendar year? They will, at least not in this chapter, but some other chapters they will fool you, like borrowing cost. You miss it, gone. Be careful when it is paid. Sometimes they say 1st April it is paid. Then you pass this entry, it is gone. Because bank never comes on 31st December, no. Payment happens on 1st of January. So instead of bank, you should say financial liability or interest payable. You have to observe the details there, what they will do. And yesterday I have given you solid proof of what institute will do. They will just set the traps for you. Okay? When is my second entry? 31st March 13. Now it is easy. Yes, students, so please pass the entries next up to the end, and then we'll pause the video and pass the entries. Yes. It happened, no, it is sitting here, no, in the finance cost. Transaction cost amortization is sitting here. No, not. It is a part of your the transaction cost amortization is sitting part of this now. You need not separate it. Yes, students. So please pause the video and complete the journal entries. We'll compare. Okay, so just I forgot to tell you, please pass till end, okay? Till end, whatever you understand. They said, look, what happens? Conversion is going to happen. With the conversion, you need to pass the entries. Think. That's yes, sure. So we'll check the answers. So my journal entries, this is your initial recognition. This is your first year entries that you have passed. Second year, 31st March 2013, finance cost 66, differential amount 83, 1,50,000, 53, 96, 1,50,000, 38, 1,11,000, 1,50,000. Okay. Now, what is the accounting entry you have passed last year on the date of conversion? Sorry? Equity component account debit to equity share capital. Okay, so this is my, okay, 5th year, one more entry, 2016. Yes. Last, you have got a preference capital because there is a principal portion is pending here. See, if it was a conversion option, that option you don't transfer to equity share capital. You will transfer to the retained earnings or some other thing. But what portion is pending? Principal portion. So you debit preference share capital of the equity capital, since they have given you the face value, differential portion will go into securities. No, if fixed number of shares are not given, then your entire instrument would have become a financial liability. What difference it makes, Dhanashree? See, the difference it makes, if it is the financial liability, you will show under the liabilities portion in the balance sheet, presentation wise. Since it is an equity portion, equity, you will show under other equity. It is a presentation. That's what, because of the classification. Classification differs, some accounting also differs because of that, that's fine. But primarily, if you have used your currency as if you use your equity shares as a currency by issuing variable number of equity shares, then this entire instrument will become a financial liability only. The difference is, I will say preference share capital in a bracket financial liability. Follow? Now, does it pass fixed for fixed? Does it pass SPPA test? Does it pass SPPA test? Oh, sorry, SPPA test is not applicable, no? So, it is, okay, SPPA test is not applicable here. So, probably I will classify it at amortized cost only, whatever I am going to do. Again, see, those things institute is not expecting at your level right now. Those examples are not there. If at all institute wanted, They would have given somewhere in RTP, MTP. So many question bank is there, students, right now. But till now, that thing is discussed only theoretically. Practical questions are not come. Then this question, no, it becomes more academic. It's very nice. You are academically asking me this question. But what I wish is, when we discuss one question of the paper, no, because right now, what is your priority? Exams. You ask me questions on that from different angles. Which line is missing in the question? That I'm telling you, no, that probability doesn't come, Dhanushri, because those questions are not there. In your entire study material, such questions are not there. Yeah, you ask me, I will tell you that way. But how it should be accounted? Yes, because since guidelines are not there, what happened? Whatever I will tell, that becomes final for you. And what is your strategy if such type of things happen in the exam? Leave it, go to the next question. You are not done it. Why you want to break your head on that and that first 1.5 hours? Do it something later. Somewhere plus here mark, there mark you would have got. Play your logic, because since already you cross that danger level, then whatever comes to you, bonus only, no? Clear? Okay. Take out next question. This question came in your examination. Does it sounds like, looks like, have you seen this somewhere? CCGPS. Then you say that this is the same previous. Exactly. This is what exam is. Okay, students. So please pause the video and do this working. Do you see any catch? No catch. Chalo. Please do it. Please be careful. I don't know what they have done in this. I want end-to-end journal entries, full. Then we will compare with the suggested answer. Okay, students. So we will check the answers. Now, I'll tell you strategies. Please keep in mind again. Now you don't find time. You don't have time there. Few minutes are left. This question has to be done. What you should try for? How many marks question is this? 12 marks, maximum marks will go where? Where you should be going. Journal entries are there, very big. You may not find that much of time to pass the journal entries. See, amortization schedule, workings. Quickly finish the workings first. And then just look at the evaluator and pass the entries like this. Because whatever you get no. Followed, no, you have to see, there are two things, students, to be successful. One is accuracy, another is the speed. I think I told previously. Accuracy means you have to solve that accurately, like preparing a tea, walking, driving the vehicle, everything accurately. And to do things accurately, you have to follow certain steps. Working 1, 2, 3, 4. So your thinking should be so much clear. By looking at the question, those steps should be there, automatically strike to you. Means you should know what you need to do. Like I will ask you, prepare tea. Do you want a recipe now from the door? Oh, step number 1, take kadai. Step number 2, put water into it. What I should do? Step number 3, put sugar. Or by tea, one sequence of steps will pass through your mind. Yes. Now, if you miss any of the steps, your output will be wrong. And the day your output is wrong, the world is going to reject it. Second is, you have to be much faster. You can't take your sweet time to solve it. Because our life itself is time bound. Examination is still time bound. So within that time frame, you have to do it and practice it fast. Followed, no? Did you see any catch here in this question? What? Or did you see any differences? This and the study material question. Sorry? Conversion? I didn't understand. Okay, one thing is they have given you the present value factors, correct? They have given you. Second, they said round off the figures to the nearest multiple of rupees. This is okay, fine, not a big deal there. That's it. Now, only one question I will ask you, the twist. Okay, let us discuss two twists which could have been possible. One twist is like, as she said, this they will not give. What to do? I will tell you now. I have to answer your query now, whether academic or whether it is your exam. Second thing, what if they would have given you preference shares face value? They issued at 180. What if by chance in the examination they would have given you the face value of the preference share? Your contractual interest rate will be on the face value, no? Now, in this question, without thinking, you assumed that it must be face value. Did you ever thought this is 180 face value? Then why somewhere some bottom they would have given face value of the instrument is 100? Gone, no? Because your entire calculation of the interest should be wrong. In that case, my equity component is going to increase. Why? Because you issued the shares at a premium. That premium will never refund, so it will be equity component. Correct? So, first thing is, they said this is the compound instrument. Total proceeds they got so much dividend they are going to pay. See, that's why then they said dividend at 10%. Their assumption is also that the face value is 180. But if at all, somewhere they give the hint that the face value was 100, then the dividend will be on 100 into 10%. Followed, no? Not on the value of the instrument. Anyhow. So they prepared the liability component. Okay, they have clubbed it together. But understand, they have taken individual values here. Now, I will ask you only one question to you. Did you use these individual values and find out the table? No, or did you use an annuity factor? Okay. If you have used an annuity factor, did you prepare this working note by adding this and total annuity factors? That's the risk we are taking. I don't know. Followed, no? Because ICAI has used annuity factor some places. I don't know when they will use, when they will not use. Let us not take the risk, no. It doesn't cost me. Otherwise, you do this way, finish. Or let us see the pattern, what they are expecting us. So they said that this is my balancing figure. Did you get 59, 83, 110? You should get exact value. Why? No, you may get a different value because of the round off. Why? Sorry? No, they have given you, but you have taken an annuity factor. No, you have added on all these values. Or did you take individually? Let us see the question. Round off figures to be the nearest discounting factor 15%. Okay. Okay. From now on, let us keep in mind. Let us observe, try to observe what they have done. Whenever they have used the discount factor, is there any factor they have used in any place? Have they used the annuity factor? Or all the places they have used this only? See, because when they come round off figures, okay, let us have take a learning, something like this. If they give me a table and they say figures to be rounded off to the nearest rupee and all, our learning is going forward, we will use these individual values. Let us learn, no. I don't know. Because they said, otherwise why they should give me this? Why they should give me this? Because the problem happens, no, we have got the right answer, but they will not, they will say, no, 0 marks. They will not tell us. That's the biggest problem there. If they would have told me, look, Baba, my expectation was you should have used these values individually. You didn't use it. Then I'll ask you, sir, why, where you told me? Have I not told this? You have to interpret it like that. Hello? Finish. No guideline, but we have to interpret it. Fine. So if they don't tell me this, we will do the annuity. Followed, no? Yes. Next, you did the allocation. It comes to 60, 338, 119, 662. Did you get this number? Allocation? Yes, Dhanush, what? You took the face value as 100. Okay, but then in dividend, on face value you took 100 rupees you took. You took this assumption. Okay. Yeah, understood. Okay, so see, when you have to take okay, let me come back again. My rule of interpretation. Chalo, in exam only, because see, one of the student took it that different way. Now question is very silent about the face value. Is the subject matter of assumption. I 100 times I have repeated in the past, 200 times I will repeat in the future. Whenever you have to take an assumption, first you should pause and think, have I seen this question anywhere in the study material? Have they taken assumption there? Previous question, what is the issue price? That is face value, or that is what is the face value in the previous question? 150 the face value. So if I remember that in the study material, the institute has taken certain assumptions, I'm repeating it again and again and again. I'm repeat throughout my sentence. Give priority to that assumption. If you have never seen, first of all, you would not be touching this question. Later take any assumption. No, does it matter? See, if you get, you get. If you don't get, you don't get. Finish. But your risk is crossed. No. After 60, you don't have any risk. No. You understood, Dhanashree? Yeah, nice. Nice thing. I want that discussion. Okay, next is the accounting for liability for amortized cost. So you said the initial accounting amortization schedule you are going to prepare. 9 lakhs is the cost. Total value is going to become 0. 123, 133, difference of 78 is adjusted. Yeah, somewhere because of the round off thing it may differ. The last is the journal entry. Now I'll come back to again your question, Dhanashree. What if the number of shares are not given, fixed for fixed? Then this portion also I would have said financial liability. This is also a financial liability. But why I will tell both? One is and both the places I will show under where I will show both the things I will show. Okay, there comes some complications. See, I have got equity and liability as a head. Second heading is equity. Under equity, I have got equity share capital, other equity. Then I have got a liability. Under liability, see, understand now, I have got the heading first called. Do you remember? What is the first heading? No, under liability, it's called a non-current liabilities. Understand now? Since India's one we have not discussed, analysis we have not done, I am just giving you a flavor of how it comes. You have got a non-current liability. What is my non-current liability? See, first of all, this entire is your liability. In the given case, 58 lakhs you will show here, 29 lakhs you will show here. If fixed for fixed test was not, it was failing, say for example, due to some reason, then both will become financial liability. Both will become financial liability. If both are financial liability, then it will never come here in other equity. It is not an equity component of compound instrument. It will be shown here only. But when it is shown here, out of this, 100% of this will be shown here only, 58, 63. But out of this, how much is going to due next year? You will give two breakup, current, non-current, which we will learn later. Current, non-current portion of this we will show here, say 25 lakhs. Similarly, after non-current liability, you start with the current liability, financial liability. And that 1 year, which is going to do in next 1 year, 1,50,000 what you are going to pay, no? That portion, present value of that 1,50,000 you are going to show here. Perfect. Got clear? Convinced? Because you cannot amortize this. Huh? Why? Because what contractual cash flows you will amortize? But this is a subject matter of amortization. That's why you break into non-current and current. Okay, so these are all my journal entries. First is the bank preference capital to this, preference capital to bank. Okay, they are split into two journal entries. we were doing a single journal. So same second year, third year, 9 lakh is the 4 lakh is the interest cost, 3 lakh 21. I can proceed further now because it's not a big deal here. The last year you debit equity component to equity capital 1 lakh 25 because they gave you face value. If they would not have given, you had a choice, either take full into equity capital or equity, simple. Balance will go into securities premium. Any doubts, students? All the doubts cleared? Face value problem solved? Fixed for fixed interest test is solved? Chalo. With this, first part we have done of splitting. And one element, last question, we have seen how the conversion is also going to work. Now let us solve more problems on the conversion. What standard says? Look, on conversion, whenever it is going to get converted, whether it's a compulsory conversion or whether it is an optional conversion. Optional conversion generally says that, look, you can convert at any point of time, else redeem at the end of third year. So, when you convert on maturity, entity D recognizes the liability component. That's why you debit the liability component, whatever accumulated balance, and recognize it as an equity. So, your accounting entry will be financial liability account debit to equity account. Now, original equity component will remain as an equity because you on day one you split it. The second portion was in equity. It will remain in equity, but head may change. From one head it may fall under, like previously, it was the head was equity component of compound financial instrument, the heading. Next, equity share capital, but it is in equity only. Understood? There is no gain on loss on conversion. In the previous question, no P&L came. Okay, take out next one more question. QA also issued 10 lakh 8% bond B series of 1 each. 1st April 2016 for tenure of 3 years. Interest is payable 1st April every year. Be careful. However, the bond holders of this series are entitled to convert. This is an optionally convertible OCPS. Previous was CCPS. Of 1 each on the date of maturity, bonds 2 shares of rupees 1 each. On the debt is which of 1 each? What 1 each it is? Face value of equity shares. This is the face value of the preference shares. Instead of receiving the principal payment, interest rate on the similar bond without conversion option is 10%. Now tell me, is this going to pass fixed for fixed test? Or is it going to fail the fixed for fixed test? Yes? Huh? It passes? How many shares you get? Huh? Where it is told? Not told. A reasonable assumption. Question is very silent. They say 1 rupee face value of the preference shares will get converted into equity shares. How much? 1:1. Now, what entry you are going to pass on the issuing of the bond? And what entry you are going to pass on the conversion of the bond? Did they ask you intermediate entries? Not required. Amortization schedule, should I prepare for this? Not required. Expect for 4 marks. And actually it is 4 marks in your MTP. Makes sense? By looking at this question, now you understand what I should do. Followed, no? So first thing, to pass that entry, I need to prepare one working note. What is that working note? Solution, calculation of debt and equity component. What is your transaction price? I straight away go, it is a working note for me, 10 lakhs. Correct? What is my fair value of debt? Okay, how many components are there here in the debt? One is I have got a principal portion. Is that principal portion, am I going to pay? Can I avoid payment? It is an optional. Who is holding the option? Holder. So that means for me it's a financial liability. So principal will be 10 lakhs. I cannot avoid it. In compulsory convertible, I can avoid it. No question of avoiding. It is by default, it is the equity only. Principal, like not payable. Are you clear now, Vidya? Into what is my present value factor? At which rate? 10%. 0.751315. How much is my interest every year which I need to pay? 8%. Okay, on 10 lakhs. So how much it comes to? 80,000. You can write 10 lakh into 8%. Now this is every year coming. So 2.48685 present value annuity. Mm. 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 Why it's offered at a compound? Okay, if it is at a fair value, then I should get this also total. There should not be any difference. If it is at a market terms, then if I find out this value, this should be 10 lakhs. Is it at a 10 lakhs? No. That means, see, suppose you are a holder, I am the issuer. Now, what is the market? If you would not have taken my bond, where you would have invested? In bank. How much bank will offer you? 10%. But why you accepted my offer with 8%, Baba? That means you paid me a premium, no? Did you not pay me a premium? This is worth 500 rupees. Okay? You paid me 560 rupees. 60 is the premium you are going to pay me. Like this, the differential amount is the premium you have paid to me. For what? For getting an option contract. Which option? How many types of options or contracts are there? How many types of option contracts are there? Only 2 types of option contracts called call option, put option. Did you take a call option from me or a put option from me? You took a call option. What is that call option? I will buy if I want. Otherwise, I will allow it to lapse. So, when you get that option, should you not pay me the premium? So, the premium is nothing but the difference between 10% and 2% for next 3 years or next 5 years. Its present value is the premium what you have paid me. That's the cost to you. Am I going to refund this? Never. That's why it is an equity for me. And that premium, that contract of that call option, how it is settled if it is executed? If this option of I gave you call option means I have written a call option. You are a call option holder. Who I am? I am a call option writer. Now, if you have taken a call option, this call option will be settled how? By cash? No. How? If you exercise this call option, how do I settle this? Whose shares? My own shares, no. Will I give you MRPL shares? No. That's why in the definition, it will go to the last definition, where the contract will be settled in the entity's own equity shares. And I received a fixed premium. I offered to give you fixed shares, then that is an equity. What if this contract we entered into an MRPL shares? Understood? That means today you are converted into bond. I will give you an option. What is that option? The option will be on the due date. If you don't want, I'll give you your cash back. If you exercise the option, my company name is ABC Limited. If you exercise the option, I will give you MRPL shares to you. Then question is clear? Question is clear? See, one option you have seen now. One liabilities component, I will repay you back. If you want, you took one call option. But when you exercise the call option, I will give my shares to you. Then you say, sir, it's a compound instrument. Why compound instrument? Because on one leg, you have got a financial liability, which you cannot avoid. This is the financial liability which you cannot avoid. On the second leg, there is one call option. You have written one call option for which you have received a premium. And this call option contract will get settled by issue of entity's own equity shares. So today you received fixed consideration. Tomorrow you will issue fixed 10 lakh shares. That's why we will treat it as a equity. Since there is one leg of financial liability, another leg equity, you call it compound financial instrument. Chalo, we will take one more scenario. Same story. Instead of my shares, I will give you MRPL shares. One leg of financial liability. Do you have any problem? No. But the second leg which comes, since I have written an all option on MRPL shares, now the second leg will be financial asset or a financial liability. Then this becomes an embedded derivative. Again question comes, should I split this or should I account it? Because if it is a financial liability, because it depends upon tomorrow favorable or unfavorable, no? Then this amount is going to change. This is my income, but from tomorrow onwards, an up and down is going to happen, no? If MRPL shares are going up, there is a loss to me because I am a call option writer. You are happy. If MRPL shares goes down, I am happy. You are sad. Followed? No, this is when from tomorrow onwards. So if it is I am unfavorable situation, this component becomes my derivative financial liability. If I am in a favorable situation, this becomes a derivative financial asset. Because equity doesn't come into picture. The last two definitions will not come into picture only because settlements are not going to happen in my shares. Last two definitions will not come here. So now only question comes, if it's the financial liability unfavorable, should I split this? Or should I combine it and pass? Because both are financial liability, no? Should I split or should I not split? For this, because this becomes an embedded derivative. For embedded derivative, there are separate rules I need to apply now. It's not your like financial asset rules. Oh, take it, account it. No, we have to see the rules of embedded derivative. Followed, no? Then it can happen that this portion also I am going to restate and this I am going to amortize. Are you clear, Vidya? Perfect, no? See, don't hesitate to clarify your doubts, whatever. Again, let me try maximum your academic things also, that is try to discuss. Yeah, because first only I told you, no, this class is not just meant for your exam, it's meant for your interview also. So please ask me more doubts. I should not encourage, like morning I was discouraging actually. Then I suddenly realized, no, doubt should be encouraged. No, when you asked me this doubt, Dhanushree, I should tell, then you should be happy, convinced. Are you clear now? Yes. So first we have done the equity and the liability component because it makes both of us richer. For me also, this question, these two questions came for first time in my entire teaching career of this effort. Previously nobody asked me. I never thought about it. Today asked me, and today only I am exploring that. I am also knowledgeable today. Okay, first entry comes what? Initial recognition. You can say initial entry. Yes, please guide me, students. You should guide me, why I am writing. I have become habituated to write. What accounting entry I should pass? Huh? Bank account debit, how much? 10 lakhs. 2, 8% bond. Financial liability, how much? 9,50,000 fair value. Liability has to be recognized at a fair value. 2 what? Option. Compound financial instrument or equity portion of compound instrument. You can tell anything. 0.5 or for 49,000. Did they ask me subsequent entries? If they would have asked, what I would have done? Prepared an amortization schedule for this. Then I would have passed the accounting entries, interest cost, this, that, payment and all. But they went for the last entry now. What is my last entry on the date of conversion? What is the rule says? The liability, since you are opted for conversion, What is my balance of liability on that day? This 9,50,000 in 3 years down the line, how much it will turn out into? Huh? Interest you have been paying from time to time. Yeah, obviously. Which one? 7,51,000 when? Time 0. When it is time 3, what this 7,51,000 is going to become? Have you repaid any component in between? No, no. 9,50,000 is having two components. So in advanced AFM, you have got this thing somewhere. Give me the breakup of in present value, how much is coming from the principal, how much is coming from the interest. You tell that, okay, this much 7.51 comes from the principal, 1.98 is called stripping. You cut that, principal separate, interest separate. So, did you pay anything of 7.51? No. Then what is happening with the 7.51? It's the unwinding is happening. So, after, and whatever unwinding happens, this gets closed, 0, because every year you are paying interest. But this unwinding, no credits, no payment. So what is going to happen with 7.51? How much it will become? 10 lakhs. Do you need an amortization schedule here? Not required. That's why, what you need? Clarity in thinking. You don't need, you can imagine in your mind only what is the amortization schedule. If you don't have that clarity in your mind, what that amortization schedule will look like, they asked you pass last year entry, you will sit and wonder, what is that balance I should be writing here? If you want, for this 4 marks, prepare one amortization schedule there and spend 10 marks worth of time in the examination. Alternatively, just think in your mind only how it looks like. Oh, this balance will become this. Since unamortized, unwinding interest is not going to happen. So, 8% long-term bond should get debited with 10 lakhs. That's why see Chalugiri of the institute, intermediate they didn't tell you. They could have told you. They are testing when you prepare. Simply you copy me or you understand what you are doing there. How come this 9.5 came here? 10. No, 9 point has got two component. Out of one component got finished in its journey of 3 years. But this component got unwinded. Followed, no? Yes. So your accounting entry will be loan. Then what entry? Please guide me. I will say option debit, because they said if this option itself doesn't exist anymore, it was an option was there, he exercised it. What is the fun in keeping that one line separate? It's just changing of presentation, yeah. Because previously, if you open my other equity, there are so many lines. In one of the line, there is one component of a compound instrument. The instrument got converted. How long you will keep that? Because what standard says you transfer. Have they told you where? No. For this, you go back to your framework. For this, you go back to your Companies Act. What your act says about the reserve. Because tomorrow, can you use this for declaring dividend? Or should it be part of your capital reserve? Can you pay the bonus based on this? Because this 49,737 represents income, no Baba. Is there any not hard cash representing this reserve? Yes, this is what you did savings by not paying. So how to account it, India is not going to tell you. That your local jurisdiction has to tell. In USA, they may say, oh, use this for declaring dividend. Then I will transfer it to the retained earnings. In India, they say, no, Baba, you don't use it. For this, I need to understand my jurisdictional laws and the conceptual framework. And what my investors are expecting. That's very important because I am preparing for investors. 2 equity capital, 2 share premium. It's not OCI. OCI is a different story. OCI is a presentation of the current year accumulations, incomes, in the form of incomes. This is not my current year. It was already sitting in my balance sheet, the day one. I never took it to my P&L account. Alternatively, I will tell you, if this option was for MRPL shares, not my shares, then it is a derivative financial asset. Why I will take to balance sheet? I will take to my P&L account because it is a financial asset, FVTPL classification. That means FVTPL, no question of recycling. OCA is only subject matter of recycling. Not my shares. Nice, no? Yeah. Super. I love it. Okay, clear, students? Okay, can I proceed further? Are you very clear why we are doing what we are doing? So, for your understanding, since what we discussed only, see this 9,50,000 what you started with will get accumulated and only 80 is you are paying. That's why this becomes 10. So, our entry would have been this bank to this, finance cost to loan, loan to bank. Every year I would have passed this entry, which they didn't ask me. And the last year I passed this entry. This is what they asked you, pass in the last year. So, what they expect probably while preparing, you do it and understand. Okay, reasoning on conversion. Okay, right. Reasoning. Why you are doing adjustments? Because I don't know, in the exam they may ask you. On conversion, de-recognize financial liability and recognize equity. Did you do that? Yes, you debited equity, financial liability, credited equity capital and equity share premium. Both are equity only, no? Original equity will remain in equity. Yeah, previously it was equity, that option value. You debited it and credited where? Share premium or equity. There is no P and L. In this process, you will never calculate P and L. Are you clear, students? Perfect. No doubts? With this, any problems, any exam questions, anything you can solve? Chalo. This is an examination question as well as illustration question. Yes, Kruti? Perfect, no? A Limited issues INR 1 crore. Somewhere they will tell you number, somewhere they will tell you number, and that number also they say INR 1 crore. Convertible bonds on 1st of July. Okay. The bonds have got a life of 8 years. Face value was 10 years. They offer interest payable at the end of the financial year at the rate of 6% per annum. The bonds are issued at the face value and can be converted into one ordinary shares at any time in the next 8 years. Companies of a similar risk profile have recently issued the debt with 8%. These are all convertible bonds. They can be converted into 1:1. Question is totally silent. So what you will assume? This must be optionally convertible. Because if it becomes a compulsory convertible, then the principal, you cannot treat it as a financial liability. So you have to treat it as an optional. No, tell me, students. Do you find any information there? No. So I have to go assume that this must be optional convertible, and who is holding? Holder must be the holding option. Provide the appropriate accounting entries for initial recognition. Calculate the stream of expenses across 8 years of the life of the bonds. What do you mean by this? Amortization schedule. That's it. They don't need to do it. Provide the accounting entries if the bond holders elected to here they told you very clearly, no? If they elected to convert the bond at the end of the 3rd year, that means this is a premature conversion. Can you give it a try? Simple, right? Understood thoroughly. Yes, students. So please pause the video, do it. Let's compare. Nice question, student. Only one question I'll ask you. What assumption did you take in this question? Or did you went with the flow? Huh? Sorry? Date of issue they have told, no? 1st of July. Huh? So, with what assumption you went? I'm telling you, you went with an assumption that the financial year of the organization is from 1st July to 30th June. God saved you. Next examination question. They changed it into 1st April. And they said financial year so and so. But don't hope for this God's grace all time. In one of the problems somewhere, not here, maybe probably, they will, I was referring, in borrowing cost and all, somewhere they will catch your neck with this thing if you don't observe. Because somewhere they will give in the middle of the year. Then, if at all the financial year happens to be April to, what if this would have come on 1st of August? Will you say August to September? That's why, if it would have come, what used to happen, no? The amortization schedule, interest you have calculated. How much interest entry I should pass this year? 9 months of this year, 3 months of the next period. Because my financial year is to April to March. So when I prepare an amortization schedule, you prepare an amortization schedule from June to July, which has got 3 months portion extra. So how much is my expense during the year? 9 months of this year's amortization schedule, 3 months of the next year's amortization schedule. Follow? Blunder, right? Blunder, no? Don't you feel like a blunder? This time God saved actually. See, in the examination this question came. 1st April only they said. Why they have to give 1st to July in the study material? Ulta. See, I say it's unpredictable. They will give you 1st April in the study material. In examination, they will use 1st April and they write here financial year. Then 18-19. Which financial year? Then you say, sir, I will take the assumption taken by ICA in the study material. Go to the study material. What assumption they took there? They took it from the April to March. Here, if they would have made April, their assumption would be April to March is the financial year. Here, what you will do in the exam? How do you address it? April to March only. Now, if it is April to March, then your interest, will your accounting entries hold good? Debit credits hold good, but the amount what you calculate, no, that will not hold good. They will cut out the marks. And this is called concept. Twisting. Looking for what assumptions you are going to give. Sharp eyes you need, no? Huh? Sorry? See, in this, they have taken an assumption that my financial year is, say, September, what is that, 1st July to 30th June. That's why when you calculated the interest for the whatever year, interest expense will be from amortization schedule straight away you take and plot. But if these financial year assumptions were different, you should have split that. I will remember now. How long you will remember? I'll see. Because one day I'm going to give you one problem, I'll tell you, solve it. In that time I will see, have you really remember what I'm discussing right now? And that time you should figure it out, which question it is, where ICA has done, which examination question it is, where they have done like this. And if at all that time you made a blunder, see, there are 4 types of people in the world. You know that? Never heard? See, first type of people are the one who make mistake. They don't learn from their mistake. What we call from them? What the word calls? Fools, idiots. You make a mistake. You don't learn from the mistake. Again, you make the same mistake. First time, people will say excuse. Next time, say idiot. Idiot, no. Because when we have got a reason, when we can think common sense, when we can learn ourselves, then it is idiotness. Like, for example, me only, why I should tell others? When it comes to share market investment, I am a idiot out of idiot. Doing the same mistake again and again for years, not once and twice. Follow? No, now I left share market completely. Now there are second set of people who make mistake and learn. Who are those? Ordinary people. Generally, like us. Then there are certain set of people who learn from others' mistake. What we call them? Smart people. They don't need, they just observe others. Others' failures they observe. They try to evaluate. Why did you fail? Oh, I did not prepare, no time, this, that, that. Oh, okay. So I have to prepare a plan so that I should not get into that trap. They are smart people. Then there are some set of people who don't need any mistakes to learn. What we call them? Wise. Intelligent, yes. We'll take them one level up. Wise. They, with their thinking only, they will figure out what is right, what I should do. Now, what we should aim for? What should be our aim? Whom we should become? Wise. We should not act. Why we want somebody's mistake here? Oh, in that mistake, some student made a mistake like this. I will not do that mistake. Why? Let us try to be wise by looking at the question, what must be? If not wise, chalo, leave it. Wise is a high expectation. What we should aim for? Smart, intelligent. How? Learn from others' mistakes. Chalo, if not smart also, what we should aim for? Being normal. Normal person. What is that? Make mistake, learn from mistake. What we should not aim for? Being idiot. Okay, now let me see what is your aim when the same financial year problem comes somewhere later. What you are aimed for. Okay, so this is the same question. Followed, no? No mistakes again. Huh? 1st April, bond life is 8 years, so and so. Everything same. Okay, interest cost. Give the accounting entries if the holders of the bond elect to convert after receiving the interest for the 4th year. What was the examination? Our at the end of the 3rd year. Okay, here the question is very silent about the 4th year interest. But in the examination, I'll tell you one more catch. Here, in the study materials, they have passed the interest entry. Did you pass the interest entry? Last year interest entry? Did you pass? No. Okay, I'm okay. But in exam, you are expected to pass the last year interest entry. Why? They have given you one line very clearly after receiving. Okay, first thing we do the debt equity calculation. 1 crore, 88,5960. So 11 lakh, 49,040. This is your debt and equity. Did you get this number? Yes, Vishnupriya. What happened? What went wrong? Vidya? Huh? Discounting factor what you took? Huh? No, 5 decimals you took. That's fine. But will you get somewhere 54? No, did you took 1 crore into 0.54? Have you done this? No. That's fine now. I'm not interested in this. 1 crore into 0.54 is there in everybody's answer. Have they told you in the question? Not there. They are not given the present value factors now. Leave it. Have you done 1 crore into 6% into 5.74? Okay, that means somewhere 11 lakhs 49,000 you must be getting. Sorry? Okay, I'm okay. It doesn't matter here. No? On the initial recognition day, that is calculation in amortization schedule. No, This is what we are, which interest we are looking, contractual cash flow. For how long years you have to pay? Very nice. Huh? These questions I am expecting. See, if it is the financial year concept, no, this interest will come for full 8 years. When you, that is when you pass the interest entry. Do you pass interest entry on day one? On day one, what entry you are passing? Bank account debit, to financial liability, to equity. So why do you need to bifurcate into interest expenses there? No, that you don't bother, no. When you are looking, see, next 8 years I have to pay. And your first recognition entry is going to come on 1st of July. That means starting from 1st of July, next 8 years you have to pay the interest. Why discounting factor? It's the same for 8 years, no? No. In first year also it is only for 9 months, no? That's okay, doesn't matter. That effect I'll tell you now. Now I'll solve. Now I'll tell. First part is clear to you. Yeah, it's a learning for you. Learning at some other places you are going to see that. So you got 1 crore, 88 lakh 50, 11 lakh 49. New transaction cost. Then, when you pass next year's finance cost, 31st July. Now, how did you get this 7 lakh 8,077? What is the question? Pass entries when? Provide the entries for initial recognition, but if you go to the examination question, they say provide entries for from financial year so and so to financial year so and so. That's okay. Previous question we have done. For this, I need an amortization schedule. And you say the first entry will be finance cost account debit, bank to convert. Did you have this number in your amortization schedule? You have prepared no stream of expenses. This is the stream of expenses. 7 lakh 8,000, 7 lakh 16,000, 7 lakh 26,000. Did you prepare this stream of expenses? Oh, you took there only 9 months, huh? No. Now I will tell you. Anyhow, nice. You made a mistake at the beginning only. See, now, if at all that 9 month, 8 month concept you need to apply. Okay. I need to pass one accounting entry. What is my interest cost? 7 lakh 8. From when? June to next July. So if I have to pass this entry on say 31st March 2013. Say for example, not 13, 12. If I have to pass this on 31st March 2012, then finance cost account debit 7 lakh 8,077 from when to when? 1st of June 2011 to 30th of June 2012. So what you need to do is 7 lakh 8,012 into 9 by 12. Some amount comes. Yes, because this year, this finance cost was not there with me for entire year. It was only there only for 9 months because I instrument I issued only on 1st July. Understood? Then things will go on. I paid how much, whatever it is, contractual cash flow and all. When I calculate 31st March 2013, what is my finance cost account debit? It is 7 lakh 8,201 into 3 by 12 plus 7 lakh 16,213 into 9 by 12. Are you clear now? Oh, so you have seen that financial year part. And you took an assumption it must be this. Fine. That's fine. But did you learn how to make it? What do you need to do? Perfect, no? Yes. So this is my stream of expenses. Principal and interest. Why? Because is it compulsorily convertible? If I go back to the question, what type of instrument it is? Compulsorily convertible or optionally convertible? Optionally. That's why they said elect. If it is optionally convertible, can you avoid the principal portion for paying? No, no. That's why both your principal and interest is your financial liability. No? it was compulsorily convertible. Principal portion you will never pay. Which question you are referring? Previous question means. In 36, if I go, I have taken both principal and interest. Because there election was not option, like they didn't tell me. See, they have bondholders are entitled to convert. There was an option. In previous question also I have taken principal and interest. Please check your workings. In 36 also principal and interest. 37 also principal and interest, because both places they were optionally convertible. But before 34 and 35, they were compulsorily convertible. That's why I took only principal portion, I took to the equity. Only interest portion I have found on the present value. This is what we discussed. You asked me, oh, where is that portion of the principal, how it became 10 lakhs. Followed, no? Please go through today. Practice it thoroughly. Yes, Vidya, are you not clear? That is a financial liability portion, because there your principal was also liability, because on day one you did not have a control over it, because it was an optional, and this option holders would have told please convert. So I had to recognize the present value of that 10 lakhs also. No? Which one? That's what, no. It's the same thing. Instead of preparing amortization, that's what I was asking. In your mind only you think what must have happened. It's the same, no. Like principal 7 lakh 50 portion, its future value is 10 lakhs. Clear, no? See, again, I suggest please go through and then thoroughly understand that these questions are all, by now you have seen what institute is doing. And once you understand, it is actually simple things, scoring things. Okay, so this is my interest expense, finance cost full 7 lakh 26. Why 7 lakh 26? Because institute assume my financial year is June to July. But here it is okay. But what if they tell you, that's what I'm trying to tell you, no. Our institute goes with that. No? You don't simply go with the questions on the face. They want you to spend time there, make mistakes, they will give you big mark, 14 marks. They say that take risk in life. If you are really intelligent, I will give you 14 out of 14. So if you don't want to, if you think it's too much of work, and if you run away from that question, they say I will not give you anything. Life goes with the simple principle of risk and reward. You take risk, you will be rewarded. And what is risk? Not knowing what we are doing. Who told? Warren Buffett told. If you know what you are doing, it is not a risk, because we know it, how to handle. But without knowing we touch, that is risk. Are you clear, students? Yes. So convertible, last entry will be convertible bond liability. How did you get this 92 lakhs? Go back to the amortization schedule. You see that the third year balance is 92 lakhs. Did you see that number? The third year closing balance is 92 lakh 1,821. That you transfer to the equity. Equity portion will remain in equity. In the question, they didn't tell you face value. So you cannot decide either you can take an assumption or just say equity capital, finish. Or equity capital, not share, equity capital. Are you clear, students? Okay, students, so since you have got one doubt, first thing I'll go back here. See, this amount you got by splitting 10 lakhs. Now, in that splitting, don't do any proportionate. Look, okay, telling like my discount factor itself is for 9 months. Don't get into that. Life is very simple. Whichever date you acquire the instrument, from there 8 years. It can be 11th of November, 11th of November 2023 to 11th of November, 10th of November 2028. Simple, life is simple. You prepare this amortization schedule. This amortization schedule will start with the 11th of November. You calculate this interest. This interest will be 11th of November to 10th of November next year. So this year interest only one portions, two portions will come. Did you pay this money on 31st March 2023? No. Because of this balance also, there will be two balances. This balance will be exactly on 10th of November 2024. So this balance will not come on my 31st March, no. So I will have another balance on 31st March. On 31st March 2024, what is my balance? It is this opening balance plus that 6 months or 4 month interest gives me one balance, no? That is this balance. For this plus certain add interest, that remaining portion minus this gives you this. But this balances will not come anywhere in your financial statement because your financial statements are ending on 31st March. So these balances are only meant for your calculations. Perfect. Clean in your mind? Yes. Very good. Yes, students, we'll start now. Okay, and before proceeding, I'd just like to tell you one thing. See, sometimes I speak certain things out of way or go somewhere else. So don't take anything personal, okay? So I hope by now you have understood me. Okay, so what I do, I just tell certain principles. See, like I told certain examples. We end up making mistakes. After my life, after I entered into professional life, made a lot of mistakes. Resigned my job, came here to teaching. Again made a lot of mistakes. Just I reflect myself. Because that's part and parcel of our life. Because without mistakes, see, it's always principles goes like this. Failure comes because of the mistake. Mistake is the starting point of a failure. No mistake, no failure, simple. Correct, no, in life. Because of the mistake, you fail. Because of the failure, insult happens. Because of an insult, you feel rejected. Because of rejection, you feel frustrated. I'm telling about myself, okay? That's what, don't take anybody personal. I'm just telling certain principle, which I just felt what it is. But one beautiful thing is, without this, success has got no meaning. If without this, if you got success, no, it's a fluke, Baba. Which janmas punya, God knows. You don't enjoy that. Because in life, what you get free of cost has got no value. Water, how much you value? Parents, how much we value? Free of cost, no. Health, how much we really concerned. It's only once the struggle gives us something, no, then it is so beautiful. Followed? So always, again, I will tell so many things because actually I am opening up myself through these lectures so that I can get connected to you all, because this is my journey. I will tell now, going forward, I will tell my journey, like where I started, what happened, all this 6-7 years, what I was doing. Okay, so none of the things, whatever I tell, you should not take personal. Huh? Nothing should be personal. It is only the principles of the nature I am trying to bring out here. Look at those principles, whatever I tell. Does it make sense to you? Does it fit within your common sense? That's what you need to check. Okay? Okay. Yes. So we'll move on to question number 38, your favorite examination question. One more. Weir Limited issues convertible bonds 75 lakhs 1st April. They have got a life of 5 years at a face value of 20. Offer interest payable at the end of every financial year at the rate of 4.5 contractual rate. Bonds issued at their face value, and each bond can be converted into one share. Okay, fixed test is passed. And is it optional? They said can be. Okay, whose option? Must be holders generally, because with the issuer's option there are no question in your study material. So question is silent, always assume it must be the holders option. Companies with a similar risk with the 6%. So how much is your coupon rate here without conversion option? 4.5%. See, percent, here 6%. Here percent in English. Now you are required to provide the appropriate accounting entry for initial recognition. Same story. Calculate the stream of expenses across 5 years. Provide the accounting entries if they elect to convert into ordinary shares at the end of the 4th year. This time, no mistake. Okay, it's a very plain question. No, on the 1st April only they have issued it. Actually, it is a repeat question of the previous question. Yes, students. So you can pause the video and again do it. Okay. So the first one, calculation of the debt equity component, same. Transaction price is 75 lakhs. See, now it is an optionally convertible, correct? So you don't have any control over the principal. So entire principal, which they may opt any time. So if we can't say which time, so we will assume next 5 years. So I'll get the present value factor 56 lakhs 2500. Interest of 75 lakhs into 4.5%. Please be careful. Face value also they may give you. It should be, interest should be on the face value. Into annuity factor. So my total fair value of the debt is 70 lakhs 24,050. So equity component is 4.75, and this difference is nothing but 6% minus 4.5% difference. This is that benefit. Follow? Then they asked me the first entry. Very easy. Cash account debit, convertible bonds to convertible equity. Same story I am going to write. Okay, in this question, I want to show you something, and I want to ask you your understanding. Then I'll prepare interest cost entry, interest cost account debit to cash to convertible. How did I get this interest cost? Opening balance of liability into 6% interest, which is going to come from the amortization schedule. They asked me streams of expenses, so I calculated streams of expense, and I 4,21,443 I did. There's no problem with my financial year here. Plain, for full year I will take it. Followed, no? Now, at the end, it should have been come to 75 lakhs, which is only the principal portion, because interest portion, which I have discounted, I'm going to unwind it and it's going to get finished off over next 5 years. But the principal, there's two portions now in this 70 lakhs. Principal portion, which is 56 lakhs, which will unwind and it will become 75 lakhs. Now, if the holders opt to convert, last year first I'll pass the interest entry, 4th year, 4,37,477, 4,37,477, to bank, to convertible liability. And then I'll pass the entry, bond liability account debit. What is this 73,91,268? The closing balance at the end of 4th year. End of 5th year, it would have been 75 lakhs. Debit, equity, whatever balances, because there is no change, to equity capital. Are you clear? My only question is, the transaction price itself is 75 lakhs today. How come you are transferring 78 lakhs to equity? What is this difference of 3,67,000? Which what you received is 75, but what you transfer to equity is 78. Huh? Interest, which interest? Sorry? But if you see, this share premium was already part of that 75 now. You split that 75 into two elements. One is the principal portion, 70 lakhs something. 4,75,000 is the balancing figure. If you remember, you started with 75 lakhs. 75 lakhs you split into two components. One portion you kept same, another you started unwinding. In the process of unwinding, you reached 73. And the total equity became more than 75. What is that extra? Which present value? You tell me, I will show you to take you back to the screen. Question is clear? Now, if you tell me what it is, then I can figure out that, yeah, conceptually you are going more deeper and understanding it. What must be? Follow, tell me. How? When I have received 75 lakhs, how on earth I am transferring more than 75 lakhs to the equity? Is there a redemption at a premium there? Have they told me? No. No. How come my equity balance increased? See, 75 lakh rupees is what I got. How come my equity increased? Equity increased when? Only when you make profits, no? Did you make any profits? Just tell me one thing. When equity is going to increase? Only one place. One, somebody gives you money and say don't return it back. Then you look, okay, should I take to P&L account and then should I take to capital? Or should I take directly to the capital? P&L is one portion of the balance sheet, no? There were, for next, Luca Pacioli invented a balance sheet 500 years back. Next 400 years, there was no concept of P&L account. P&L account concept started 100 years back. What is that? It's the presentation. How come your equity increased? Equity increase means my profit increase, no? Net worth is my profit. What is the true definition of profit? What is profit mean? Today, if I ask any student, what is profit? Profit says, sir, what is coming in the P&L account is the profit. Arre Baba, that is a statement. In reality, what is profit? What is my net worth last balance sheet versus what is my net worth this balance sheet? That is my profit. The breakup you want to know, go and see my P&L statement. So I must have my net worth increased, no? Where we are saying? Every year I have to pay the interest. No? I paid, no? I prepared you did I not pass this entry, Baba? On 2022, did I not pay? I paid, no? 30-year interest entry I paid, no? That's why I am transferring how much? Only 73 lakhs, no? Unwinding also didn't happen, no? Okay, I will take back you. See, first of all, you understand that there must be some income, no? For me. Otherwise, how equity is going to income? My income is the difference between what I actually pay and what I actually claim. What I pay is 4.5%. Since it is an off-market instrument, what I discount is a 6%. The difference is my income, no Baba. When market is offering at 6%, I am getting this loan at 4.5%. Will it not going to increase my equity balance? That's what reflection you are seeing in the final entry now. See, if you would have completed all 5 years, then that increase will be exactly that opening equity, different 4,37,000. Since you did it only for 4 years, no? That's what you get, the difference of only 4 years difference. Which one? Maybe there. Because we clubbed both together, no? There. I don't know. You can go back again. See, always see, students, if I would have continued all the 5 years, simple. What is this balance? 75 lakhs. What is this balance? 79 lakhs, 75,000. Then I'll ask you that what is the difference between, your transaction price itself is 75 lakhs. How your equity is 79 lakhs? Then you say, sir, that is the same opening component. Premium, what you received, you didn't repay. That's your income. What is the premium? Present value of all the future benefits. Difference between 6% and 4.5%. When we say balancing figure, no, that balancing figure is the present value of difference between 6% and 4.5%. That's because of this benefit, my total equity is going to increase. Here, it is not exactly 4.75 because one more year my unwinding was pending. Before that only they converted. If I would have converted after all 5 years, the increase in the equity will be exactly equal to my first differential, that portion. Are you clear? Yes, let me go to the previous problem. Okay, so this is my previous question, correct? I converted this. So my transaction price is 1 crore, INR 1 crore. 92 lakhs plus 11 lakh whatever equity. So how much total extra I got? 3,50,861 is extra. This conversion happened at the end of third year. I'll go back to the previous amortization schedule. You take these three interest minus 18 lakhs, you are going to get that exact, because that's the benefit you got, no? And option holders, they didn't wait. If they would have waited all the years, then the income would have been for you is that difference between 1 crore and 88 lakhs, which is your balancing equity. See, one way of looking is equity means equity balancing figure. Second way of understanding, what is that? It is that differential income, its present value. Knowing that is a concept. Solving it is a procedure. Procedurally you can solve it, but somebody somewhere they will twist it. They ask you, what is this differential? Can you explain it? That's my income, no? Have I not saved? See, accounting standard ignored your notional income. Ind AS is going to consider your opportunity cost and the notional income. That's the difference. Now you have much clear? So this is what we discussed. I hope you are very clear with this discussion. Yes. So now we will move to the very important part called early settlement. See, early settlement rule says what? See, if early conversion happens or conversion happens on the due date, does it make any difference for you? Simple. You say, sir, there is no P&L account. Go to the amortization schedule. Whatever balance is lying there, you debit it, credit to the equity. If they tell you number of shares, face value, balancing figure is the equity capital. No P&L. But if the early settlement happens, that means cash you pay. Then again you need to split the differential amount into equity and liability, because when you received the cash, did you not split into two components on day one? So when you pay the cash, conversion, that problem doesn't come. Again you have to split. The loss on the liability will be P&L, because on that day, what liability I should have paid versus what I actually paid. You remember that employee loan, prepayment happened, we did that, P&L we got. Equity will remain in equity only. No change, don't recognize. Take out question number 39. The amortization schedule of the instrument is set out as below. Oh, nice. In the question, they started with the amortization schedule. Opening balance is okay. And see the balances where they are given. They are told you cash flows. Contractual. That means on day one you received 1 crore rupees. This is 1st July. Okay, now you are very careful. 1st July means. On 30th June, you paid 60. That means this must be 6% instrument. You make a guesswork. But 10 lakhs. No? Now, interest cost is 83,000. What do you mean by this? That means this must be your EIR. Can you tell me what is my EIR rate? Sorry? 9%, very good. Others able to figure out? Come on. Come on, come on. See, now by now you know conceptually, I hope. What is my EIR rate? 9%, I am okay. I am okay with you. Perfect. But did you figure out that? And see the way they give, frame the question, entire format they changed. Because this EIR will be calculated on the opening balance of the liability. 10 lakh is the cash flow. There are two component, equity and liability. They only gave you. On 9 lakh 24, 9% you calculate, you get EIR. Minus 60,000 you do, you get 9 lakh 47. See the way, weird way they give you. So that you get confused. But a conceptual hold, you will not, no confusion there. So equity will remain equity, constant. These balances will change, and at the end of the year, this balances become zero. Perfect, no? Only thing is they didn't give us the way we wanted, we have been used to. Assume D has got an early redemption option to prepay 11 lakhs. When? On 30th of June at this time. So, when I have one more year left, because next year if I have to pay you, I have to pay you 10 lakh 60. But right now I have got an option to pay you 11 lakhs. And 30th June 2003 actually exercises that. That means he doesn't pay you no more. Instead of this, he pays you 11 lakhs only right now, and close this account forever, finished. Then no more loan account, no more equity component account. As on 31st June 2013, at this date, the interest rate has changed. That's why he prepaid. No, otherwise he is mad or what. At that time, D could have issued 1 year maturity 31st 2004 at the 5%. See, what is your contractual cash flow now? What is your contractual rate? 6%. Now, interest rate changed, and D Limited has issued this. That means this must be financial liability for D Limited. Which question is very silent. Huh? You have to figure it out, all these things. Now, what happened? On the last year, every year you are paying 6%, 6%. Now, interest rate changes. AFM comes into picture. Bond redemption evaluation. Should I redeem or should I not redeem? Then finance person will prepare one calculation. If I redeem, how much benefit, present value is. If I not redeem, how much benefit. Then finally the finance person will say, yes, redemption makes sense because we save money. Correct? Then they actually redeem 11 lakhs here. Why? Because the rate of interest has fell down. No. Makes sense. No. Why I should continue and pay one more year 5% to you? Right now I will take one loan at 5%, repay you. So next year instead of paying you 6%, I will pay them 5%. That evaluation we are not supposed to do right now because it is a financial evaluation. The implication of that redemption is going to come in accounting now. That's what we are supposed to do. Calculate the value of liability and component when they have already calculated, no? Then will I, even if we calculate, and we don't have any information to calculate, they have given me when they are expecting. When this 11 lakh is repaid, see question, they expect in that you calculate the debt and equity component because it's the early maturity. And determine how it will be accounted now. Oh, you say, sir, if that portion will be paid, there will be P&L recognized, equity will remain in equity. That is a determination. Are you clear? Yes? Now tell me. Huh? Which part? Okay. First of all, on day one, I will tell you the story now because generally we are used to from our childhood, starting from beginning. No? They didn't start the story from the beginning. I will start the story from the beginning. On 1st of July 2011, this company issued one instrument, D Limited, issued one debenture at 10 lakh rupees at 6% every year. But at that time, there was an option also. What is that option? Not conversion option. That was an option to prepayment. Follow? Now that option, if actually this is not a compound instrument. Is it a compound instrument? Did they ask you examine? No, you would have got caught. What instrument it is? It's not a compound instrument, no. Is it a compound instrument? Why? Why it's not a compound instrument? Very good, since you asked, you didn't understand, that's why one more discussion came now. Is it a compound instrument? Why? Can you examine the instrument and tell me what exactly it is? What type of instrument it is? Then why they bifurcated into two portions? See, now you have given an option to prepayment. It is a derivative option. Followed, no? So, a prepayment option becomes an embedded derivative. It's an embedded derivative because that option has got a premium. The premium is nothing but the difference between 9% and 6%. But that embedded derivative, you separated it. Why? Because we will learn in the next chapter. And they gave you a separated breakup. Okay, for time being, not required that much. Now, since you have issued a convertible, prepayable debenture, not convertible debenture, at 6%, at that time market rate was 9%. Step 1, you found out the present value of the future cash flows. What is your future cash flows? Principal plus interest. And you got one present value, this. And you passed one beautiful journal entry, bank account debit, how much? 10 lakhs. To financial liability, how much? 9.24. To a derivative, whatever it is. Since you need not repay this premium, you treated it as an equity income because you have written one option to them of prepayment. Since a prepayment option is given, you are an option writer, the premium amount is your income. No, this is what we learn in derivative chapter of AFM. For a writer, option premium is the income. That's why they treated this as an income, and that income is sitting in 75,939. Probably it must have gone to P&L account. From P&L account, it must have come in the retained earnings. And what they show in equity is nothing but retained earnings. So forget this. It will remain there. Okay, not a retained earning, it is there. Now, after 3 years, you should have paid full. But there is a prepayment option. Who is holding this option? The issuer himself. So what I will do now, at the end of the 3rd year only, I will repay it. But when I prepay it, I need to give 2 components. Because one portion, initially I have written out as an income. Because this was not my income actually. Because when I am repaying, will I not portion some portion of that also I will repay you? Because if you would have stayed with me for full 3 years, 75,000 would have become my full income. But since I am repaying you something, you will not accept unless I will give you some premium. Otherwise, the holder will go to court now. They say, sir, look, sir, this person is doing something like this. He told me he will pay me 6% interest for 3 years. The day market rate went down 5 years, now he is telling he will repay. Court, you tell him something. The court will say, okay, Baba, do some justice to him also. Pay some premium, no? Close that. So that's why what I should have paid you right now, present value of 10 lakh 60. But what I pay you 11 lakhs, which is more than 10 lakh 60's present value. So that means there is some amount of premium I am paying you back, no, for accepting my prepayment. Followed, no? So that's what we have to calculate and determine. Okay. Payment of 11 lakhs. Can you please provide the breakup? How much is under contractual and without any obligation? Now I will tell you why it is an equity portion. You paid 11 lakhs, no? How much under contractual is supposed to pay? 10 lakh 60. 10 lakh 60 when? Next year, no. Right now if I have to pay, contractually what is my obligation? What max to max court will say? Pay the present value of 10 lakh 60, correct? The balancing is the equity, is the premium what you didn't add any contractual. Go back to the definition of equity. What is the equity? There was no contractual obligation to pay cash and you paid cash. That's equity, which is nothing but loss, P&L. Followed? Yes. So we'll go back to the solution. Right. In days 32. Okay, right now don't get confused, embedded derivative and all. Just understand how to account this prepayment. Require amount of rupees 11 lakh to be split into equity and debt. They say that, look, the day you bifurcated on day 1, you made a 2 portion out of it, right? How do we know? Because they have told me in the question only. The same way you have to do it ulta when you pay them. However, on 30th June, interest rate changed to 5%. Just consider this for fair value calculation. That means how much I need to pay right now is 10 lakh 60's present value, not at 6%, because 6% was 2 years back. If I have to pay right now, what is my right now interest rate, market rate? 5%. So find out at 5%. Are you clear? Differential portion, equity. This problem we didn't face in that financial asset, early settlement. Compare it. These questions you have to compare it with the financial asset, early settlement. Now write allocation of the purchase price, prepayment. Allocation. Yes, Vishnupriya, are you clear about this? Okay, please go through, and again my suggestion, please compare with the fixed financial assets, allocation of repurchase price. How? Same story. Transaction price is how much? 11 lakhs. Kriti? Clear, no? Not getting confused, no? Minus fair value of debt. On today's day, what is my fair value of the debt? See, 10 lakhs I need to pay when next year into what is its present value factor at the rate of 5% for 1 year? 0.95 2381. Doesn't matter, you can consider four decimals also. 0.952381. How much interest you need to pay next year? 60,000. This is your contractual obligation, no? Into 0.9524. Or you could have said 10 lakh 60. Maybe in the examination, they say prepayment is going to happen 2 years from before 2 years. In that case, you need to tell, oh, 10 lakh rupees, I have to pay 2 years down the line, its present value, twist in the examination question. Next year interest and the second year interest, annuity factor for 2 years. This taken together is the present value of the debt. Right now at the new interest rate. That's why we went for prepayment. No, if interest rate is not changing, why I should change? Why I should pay premium? Why should they accept it? Question is also silent, no? Who is having the right of prepayment? So we might assume that, okay, with the, I'm trying to offer you, sir, will you accept it? Oh, premium, no? Chalo. How much you pay me premium now? 90,000 rupees extra. This will be your loss. Initial day, that was your gain. You received the premium. Because market rate was 9%, you issued at 6%. Are you clear? Okay, now how much is your gain or loss on early settlement? Did you made a gain or loss on early settlement? Okay, so we will take two portions. We will take liability, we will take equity. Did you made a gain or loss? How much is the redemption amount allocated to equity liability? 10,09,523. That is, you out of 11 lakh what you paid to bank, 10 lakh you give to liability, 90,477 you give to equity. What you are supposed to pay on this day? What is the book value? 9,72,476. This was you are supposed to pay. Go to the question. Look at the book value. How much equity was there? 75,939. You are supposed to pay this much. So the differential amount becomes your loss on settlement. The meaning is something today, right now, you should have paid this, which is nothing but the present value of the future cash flows. Ulta, you offered more than that so that they will accept your offer. Out of that, this much portion went to the liability, because if I had to look at the fair value, this is the fair value. So I paid more than the fair value. This is your total loss. This was your previously recognized income. Now you ended up paying more, 14,000. But standard says recognize only loss of this, not of this. Equity will remain in equity. Only when what goes to P&L account? Not both. Only 37,000 will go to P&L account. So, liability loss is recognized where? In P&L account. Because it's a liability settlement, third party settlement. No? You have taken a loan from the bank, 1 lakh rupees. Next day, bank manager will call you out of your, as a gesture of honor. You need not pay full 1 lakh back, only 98,000 you can pay. Are you happy or sad? Happy, no? Why? 2,000 rupees straight income. Follow? Your parent has given you 1 lakh rupees. Next day say, you need not repay me 1 lakh back. You just repay 98,000. Are you happy or sad? They gave you 1 lakh rupees and they say, you just repay me 98,000 only. Are you happy or sad? It doesn't make any difference. Their money is your money, no? Doesn't make any difference. That's why it will not go to P&L account. Parents' money, when parent give me, no, it will not go to P&L account. It will go into my capital account. Understood? Sorry? I will show you now. Now we will pass the entries. Journal entry, nothing else. Language is journal entry. And write loss on equity will remain in equity. Loss on equity will remain in equity. That means P&L doesn't come. That's it. Now, who should pass the journal entry? I should pass or you will pass? Or you will guide me? All numbers are there with you. It's only journal entry you have to suggest. No. Okay. Based on your guidance, I will write the journal entry. Okay. Heading called journal entry on repayment, which they didn't ask you in the question. Did they ask you in the question? No. They said determine how it is accounted. You explained. No. You explained everything. Out of this, so much allocation is going to happen. This is going to happen. This is going to happen. But you asked me, you may not have understood the last sentence. It will remain in equity. What is the meaning of this? For this, we will pass journal entry. In bracket, we will write not asked. So, for better understanding, we will write the journal. Can you tell me the journal entry shows? What is my journal entry? You tell, I will write. Financial liability account, debit. What? Sorry? How did you get that 10 lakh? Okay, okay. If you tell me, I'll write 10 lakh, 9,000, 10 lakh, 9,523. Okay. Sorry? Equity, I'll debit. Equity component, how much? 90,477. To bank, how much? Even lakh. What is the difference? Debit or credit? How much? Okay, I can club now. You tell me here only, 2 only you tell me. 37,047. Loss, other equity, 14,538. Will it tally now? No, even though you keep separately, ultimately this is the entry. That's what I'm wondering. How do you give this debit unless you have got a credit there? No, I want that. No, I want to combine. See, first of all, understood? No, you don't have that much of credit. So, when you say financial liability, What is your existing credit? 9,72,470. See, one option is upgrade it, then debit it. If you want to upgrade it, what accounting entry will pass? P&L account debit to financial liability, because you incurred a loss of 37,000. No. By passing entry P&L account debit to financial liability, the existing liability is going to become this, and then you debit financial liability to whatever it is. Okay, that's why you wanted that. Okay, anyway. So 9,72. But how do I go to upgrade this? I should have debited P&L. So can I write, say, loss on settlement in bracket P&L debit 37,047 taken together 10 lakhs. Then do I need that equity anymore? Equity component. Do I need it anymore? No. How much? 75, 939. But what I pay is 90,000. Again, I can recharge it and reverse it. Rather than, can I say reserves and surplus? Say equity or loss, debit 14,538, and say to bank 11 lakh. Are you very clear? Now that's what they say. Look, the loss what you incurred on that equity component, keep it in the equity only, in the balance sheet only. Don't try to bring it in the P&L account. That's it. Because it is your equity loss. You can do it separately also. The left, in fact, journal entry only they didn't ask. In the ask, you can give it chronologically. First, you recognize the loss, upgrade the debenture liability. Then you recognize the equity loss, upgrade, take it to the equity. Then you finally pass one beautiful entry, debenture account debit, equity account debit, to bank 11 lakh, finish. These two things won't come in the final entry. And if you see, all these are working, no Baba, just now we did this. All interconnected. Clear? Yes, so we will move on to the next examination question. Important, I think I have marked it important. On 1st of April 2014, S Limited issued 5,000 number, okay, convertible debentures. Okay, so these are convertible with a face value of 100 each, maturing on 31st March 2019. 15, 16, 17, 18, 19. This is the first thing you should do. 5 years. So how much it comes to? 5 lakh face value, if at all they had issued at a face value. The debentures are convertible into equity shares at the conversion price of 105. That's 4K. That means with the premium it's going to get converted. 100 rupees is going to get converted at 105. Interest is payable annually in cash, because these are debentures, no? Interest portion is your financial liability. At the date of issue, S could have issued non-convertible debenture with a coupon of 12%. That is that off market here. The difference between 12 and 8 is nothing but your equity component. The premium, what they paid you for getting this conversion option. Now, who is having the option here? Question is silent, but since you understand the market rate was 12 and you have issued it 8, that itself means that option must be in the hand of holder. No. If its situation is like this, you pay 12%, but the market rate is 10%, and they are convertible option. Option is with the issuer. That's why I paid you some premium. I'm paying you 2% more because of this. I'm holding this option. Since I pay you less, it itself means that the option must be with the holder. That's why you must have paid to me. Now what happened? 15 over. So first is I will pass one normal entry. I will prepare an amortization schedule. Pass 15th entry, 16th entry, 17th entry. Finish. Now on 1st April, that means when 2 more years were left, 18 and 19. The convertible debentures got a fair value of 5,25,000. Its market price was 5,25,000. I can say it as a fair value means what? Intrinsic value. Its market price on that day was 5,25,000. Then immediately this guy, who is this? S Limited, tendered one offer to the debenture holder to repurchase the debentures. Now we understand the previous question. So prepayment option may not have been there. It must have been like something like this. Question is silent. No, they simply give an amortization schedule. That means they must have issued one convertible debenture there. Suddenly there was a 5% to 4% to 6% to 5% fall, and you offered, okay, take this money back. No, don't go for conversion. So something like that must have happened here. 5,25,000 was there. It was convertible. 5,25,000 rupees was the market price, and they offered, okay, to repurchase the debenture at 5,25,000. We said right now, we said, look, 2 more years are there. At the end of 2 more years, one, you can get the cash or you can convert the shares. Right now, see, good opportunity is there. In the 2 year down the line, interest rate may fall. There can be, what is that called, a recession can come. My market prices will go for a toss. You will end up getting only contractual cash flows. Since the interest rate have fell down now, the prices of the bonds are very high. Inverse relationship. Do you want this? It is a financial decision, which the holders accepted. They are also intelligent people. At the date of repurchase, you could have issued a non-convertible debenture with a debt to term bearing a rate of 9%. That means my rate of interest, what I am paying you right now, 8%. But that day, the market rates have increased. That's what. These are all questions which we cannot question in accounts. If we were doing AFM, now we will question this. Why did you refund this? When the market rate of interest have increased, you could have continued paying a lower rate of interest. Why on earth you offered them at 5,25,000? CEO will fire the finance person. Accountant cannot ask all these questions because all our financial decisions. Our job is, okay, they offer, the people accepted, and we have to account it. But on this day, my fair rate of is 9% at which this should be valued. Examine the accounting treatment in the books of S Limited by passing appropriate journal entries when at the time of recognition, examine, and you have to tell, is a financial instrument, compound instrument, story, at the time of repurchase of the instrument. Or show the accounting entries in the books at the time of initial recognition, at the time of repurchase, and they have given you 5-year discount rate. Which rates are applicable for me, students? 8, 9, 12. Which rates are applicable? When? On initial, 12% becomes applicable for your first amortization schedule. Then on conversion, split is going to happen. Here also there is one split. Which one? 5 lakh. 5,25,000, here also there is one split. But when you do the split, that 2-year money what you are going to get, no? Fair value, again you have to find, no? That you will take 9%. Follow? Okay, amortization schedule and all, they are not given. Examine theory, you write. See, you have already learned examination theory. Means if they say examine the accounting treatment, see, in the solution, theory is not written. But in the examination, look into the marks. 5-mark question they give, straight away solve it. 8 marks, 12 marks they give, or to be on the safer side, write a theory. Oh, this is the compound instrument because there are 2 streams of payment. One is the principal and the interest portion, and there is one conversion option. That's why this is the compound instrument. Okay, so straight away we'll start with the calculation solution. Are you clear now, students? In this solution, there is no theory. That's why I'm not writing theory. Exam, be careful. Look at the marks and write the theory which we have written previously. Solution. Debt, equity, breakup. Transaction price, 5 lakh. Today I received 5 lakhs. No? Yes. Can you tell me the fair value, less fair value? Of debt? How many components are there, Vidya? Obviously, cash flows are only two, principal and interest. Am I going to pay the principal? Yes, it's the convertible option, not compulsorily convertible, into 12% present value factor 0.567. Do I have interest? Yes. How much? On 5 lakh, 8% contractual cash flow, 40,000 into 3.605. These are all compulsory for me to pay unless they opt for conversion. And when they opt, God knows. If they don't opt, I may have to pay it. So I will get the equity portion 72,300. And this is nothing but the difference between what I would have got minus what I actually got. It's present value. Provided this loan will stay with for next 5 years and I will convert from one head into another. Till that time I will keep it one line item called a compound instrument. So write a note. Rupees 105 is conversion price of debenture into equity and not redemption price. You took 105. We should tell, no? Why you should ask me, others should have asked me. See, one student assumed. But you have to see 105, is it my contractual cash flow? Is it my, have they told you, if the conversion is not opted, you will pay redemption 105? Have they told? If at all they would have told, then you would have taken in 5,000 into 105 you should have taken. I should have asked you, please you do it yourself. Then a lot of mistakes would have come out. But nice. Followed, no? It is very clear, no? You are not paying only. If at all they asked you, how much you will pay? 100 face value. They ask for conversion. At 105 they will convert. That is a different story. Oh, there is a premium involved, sitting and all. That is a different. Followed, no? So, it is a redemption price. Therefore, liability will be at rupees 100 only. How minute, no? How small, how important at the same time. So, are you clear about this note? Yes, we are done with the first one. Pass the entry, initial entry. What is my initial entry? Simple. Now, any kid will know now. Bank account debit to debenture financial liability to debenture equity. 5 lakh, 4 lakh 27, 72, 300. This is my accounting entries. Yes, first part of the question they asked. Now, what is the second part of the question? Did they ask me stream of entries? No. Be careful in exam. Did they ask me the subsequent entries? Prepare a schedule of entries? Nothing. They simply ask me, what is my entry on the redemption? Can I pass the entry straight away? No. I need an allocation. Correct? So, write second, allocation of repurchase price. What is my transaction price? 5,25,000. Again, be careful in the examination. They say that fair value was 5,25,000, but what the company offered was 5,35,000. What is my transaction price? 5,35,000. See, fair value was 5,25,000. That's the market price. When if you offer 5 lakh 25, then why debenture holder should accept your early redemption? They say, sir, if I have to sell, why I should sell back to you? I could have sold to some third party. No. So in order to lure you to sell your debentures back to me, I may offer premium on that fair value, existing fair value. In such case, transaction price is 5 lakh 35, if at all. What you actually pay, that is important, not what was the fair value at that time. Here in the question, fair value and your payment value was one and the same. Understood, no? Now, I am telling you a possibility of a twist in the examination question. Not there, so straight away 5 lakh 25,000. Minus, what was my fair value of debt on that day? Please guide me, students. You tell me the number, I will note it. You need not calculate. You tell me the number, I will write it. I don't want full number. I want the calculations. 7 lakh, I should write here 7 lakh, or outside you are telling me. No, I want inside. So that I am very clear what I am writing here. Sorry? Why 5 lakh? Because this is principal I need to pay into 5 lakh when I have to pay. This is when allocation of repurchase price is happening when? On 1st of April 2017. The life of the instrument is 5 years. 3 years already passed. Today, I am looking, okay, I am paying, if I have to pay right now, contractually, I should have paid 5 lakh 2 years down the line. As per the amount, see in this question, they didn't give you amortization schedule. By looking, previous question, they nicely, they prepared you. Used to spoon feeding, one amortization schedule was sitting. By looking at that only, you told, oh sir, 10 lakh 60 I have to pay next year. This year, that amortization schedule should be there in your mind there. When you are paying this 5 lakh? 2 years down the line. So what is its present value right now? At which rate of interest? 9%. Right now interest market rate 9%. So it is 0.842. I did not find out the future value, no, Dhanashree. See, 5 lakh 25 I am right now I am paying. Out of this, contractually how much you are obliged to pay? 5 lakh 25 you paid. Is the full 5 lakh 25 contractual obligation? No. Sir, you say out of this, sir, 5 lakh is something what I need to pay 2 years down the line. And every year 40,000 for next 2 years I have to pay. Previous question, 10 lakh 60, you clubbed 1 to 1, multiplied with the present value factor. If you refer the previous question. There also we did a split there, 10 lakh separately, 60 separately. But maybe institute suggestion, no, 10 lakh 60 they will club and do it. In this question, into present value and effective factor 1.759. Have you not understood this split? Yes, see, you have to understand. Otherwise, it is very difficult to touch the examination questions. Yes, Dhanashree, no, you are not convinced and you are not clear. Tell me, what is your problem? You are not clear. What you are not clear? That you tell me. No? At least I can, from your face, I can make out what you are not clear. But I don't have telepathy, okay? I have not learned. Go inside your mind and find exactly. I wished. Book value of the liability is already there. Somewhere, something is there. That which have to, should I calculate right now? No, that is in the next. That is the next step I will do. That I am doing next, no, Baba. Next, I have to find out my profit or loss. To find out my profit or loss, I will compare, okay, out of 5 lakh 25, what you paid. You gave to breakup now. Next step, you see, what is my book value versus what I paid. That is my P&L. What was my book value? What is what I paid? That's the equity. That's the next step, no? Yes, Vishnupriya, what is your doubt? Sorry, loudly. You didn't understood this allocation. You paid when 1st April 2017 you paid. Did you have an obligation to pay right now? No, but you paid. Chalo, out of this, there are two components actually. One is your contractual obligation, because today's day or tomorrow you have to pay something. And there was something that was not required to be paid, which is you paid out of to attract customers, discount, something like that. No, today or tomorrow, how much you have to pay? 5 lakh. When end of second year, 2000, this is you want to pay 31st March 2019, you have to pay 5 lakh. When you have to pay 40,000 rupees on 31st March 2018, 31st March 2019, 2-year interest you need to pay. If I ask you, forget contractually, what is your, if you have to, no profit, no gain to both the parties. In foundation, did you study that? Account date, average due date. Average due date is a middle financial day. If you have got different payments to be done on different days. If you want to arrive at one day where all the different dates values you will settle at one day, where there is neither profit to you nor loss to you, neither profit to me nor loss to me, that is one average date. Like this, if at all the future payments right now I want to make with no profit, no loss to both the parties, then I will find out the present value of the future cash flows. Followed, no? So if I would have used the same discount factor of say 12%, you would have found out the book value. But you are not using the same discount factor, you are using the 9%. That's why this is the amount of loan you should have paid considering today's fair value. What you paid? 5,25,000. So the differential portion will go to your equity. Please go through, students. And again, next class, I am open. Sorry? 1st April 2017, I believe. 1 minute, let me see. On 1st April 2017, 17 interest you paid, 18, 19, 2 years. 1st April 2014, it was issued for 5 years. 15, 16, 17, 18, 19. 16, 17, 15, 16, 17, 3 years finished. Now you are on 1st of April. 18 and 19, 2 more years are pending. Perfect? Yes. So you got this component. Now we will go for the P&L, right? Gain or loss. This time I am going to compare it with the, I'll call it debt, I'll call it equity. How much consideration allocated? 4,91,360, 33,640. This is what you actually paid. On this day, less. What is your book value? Book value? Where do you find the book value? Amortization schedule. Have you prepared an amortization schedule? Have they give you amortization schedule? No. Now, when they don't give you, you have got two options. One, in your mind only have, it's very difficult. Figure out the balance. Option number 2, prepare one amortization schedule, waste of time. Option number 3, what is amortization schedule? Anytime balance is nothing but the present value of the future cash flow. How many cash flows are there now? You have got 5 lakh and you have got 40,000 for next 2 years into present value factor at 12%, 0.797 into present value factor at 12%, 1.69. Is it not going to give you the book value at any point of time? You remember the last column I used to show you. This balance is nothing but the future cash flows. Amortization schedule, opening balance itself is the present value of the future cash flows. No. Like this, no, you grind it in the mixie after solving all these problems. Which one? Amortization schedule, equity component, And what you prepare? You prepare a juice, no? By putting in the mixture. You drink it. Is it done? No. One day should go. You should digest it. All the vitamin, protein component your body should take. Then you are ready. Full healthy person. They will twist. It looks like a child's play there in the examination hall. They'll change the format. You laugh. Follow? No? That's your job. Huh? Mixture, you don't expect me to do the mixture grinder and all. That you have to do. I'm telling you how it is connected. So this when you do, you get 4,66,100. Did you make the gain or loss, students? Gain? Okay. You have taken a loan or understood, no? That's why you see this type of thing, no? Understand the numbers there. I cannot give you plus minus because in the exam they may twist that. If you learn the procedure, oh, format is like this, plus means like this, then you get caught there. So understand what is the meaning of this. This is what you paid. This is what you should have paid. Lost, no. You paid more than what your book value. Accounting entry will be, your liability will be debit with 4,66,000. Payment cash is going to happen 4,91,000. Here, you are supposed, you paid this. Already you are sitting with the profit. So this is a gain for you. Initially there was a gain, your gain came down. Instead of this, you could have got it from the amortization schedule also. Will you pass the journal entry, students, now? Yes, students, so please pause the video and pass one single journal entry. Single journal entry. Don't give me the split entry. I showed you previous question, single entry only. Yes, students. So we'll check the numbers, check your journal entry. So first is, you have debited debenture liability with 4,66,100. How did you get this? Book value. Equity 72,300. You don't need it anymore. Loss on settlement 25,260. Difference between this, you figured out it is a loss, and by incurring that loss, because it's an unfavorable situation for you, you paid more than what you were supposed to pay. Now, since you made a profit there, because already there was this profit, this should have gone to profit, but that profit was reduced by this. That's why reserve surplus is going to get credited, and 5,25,000 you are going to pay. Got this? Anybody did any other entry? Sorry? 33,000, 38, no? Down you put how much? How do your accounting entry tell it? Accounting entry tell it? Okay. I understood. You must have taken the difference between these two. Now tell me one thing. Okay, fine. This, is it not a separate line in the balance sheet? It will still remain there. No, where it will, there is a confusion. No, in fact, you got perfectly. But you remember, one ledger account is still sitting. When next year audit is going to happen, no, somebody will ask you, what is this ledger balance? You say, sir, that ledger balance, one debenture was there. When? Last year. What is it, that debenture available still now? No. Then why you kept this? Because you closed it by taking some difference and all. Well, chalo, perfect. Trial balance tallied there. But one ledger liability sitting, one item sitting in the trial ledger. That's why you have to close this. That's beautiful accounting. This is the beauty of accounts. I really love. Sometimes I wonder whether I really love audit or whether I love FR. No, my love is audit, okay, from beginning. It is there inside my heart. I love it because audit changed my life. I would not have been talking to you if audit was not. Okay, some other, that experience and all I'll tell you some other time. But I don't know, FR also so beautiful, no? From one side you see. Anyhow, since your now favorite question came, favorite time, fun time for you. Okay, students, so please pause the video. I don't want to read also. See, one thing here, wherever they want, they will tell you very specifically. None of the examination we came across this. So if they don't give you, take 3 digits, 4 decimals, 8 decimals, 6 decimals. If they give you present value factors, use that, and probably use don't use an annuity, use the table only. But if they tell you limit to 3 decimal, limit it to 3 decimals. You see, they give clarity to us. We follow their instruction. Yes, so please pause the video and do the working and see how it is different from the study material question or not.